All right, well, thanks, Danny and Nathan. We'll get my slide deck pulled up here. And I think the general theme this year is opportunity. You've heard that word a few times already this morning, and I think that, this is by far, even though doing meetings by Zoom isn't a lot of fun, this is by far the best year we've had in the last 7 as far as the message goes. And that is, we're coming into a year where we can lock in profitable prices. We're coming into a year where hopefully we've got some tools like the guys were just talking about available to you to be able to lock in some, try to improve yields this year. So we've got, I think, a good revenue opportunity ahead of us in 2021. This may or may not be historically accurate, who said this, but you will not go broke taking a profit. Again, that may or may not have been George Washington that said it, but the point is that we've got opportunities to lock in profit this year, and we don't really want to let them get away. So in my meetings, these are really the topics that I discuss. This is kind of what I do with NAU Country Insurance. My background is in marketing, but it all starts with a crop insurance policy. And if you're going to build a base of a successful revenue management program, you have to be able to choose the right insurance program to be able to help you in that given year. And some years that's going to change a little bit. And this year, one in particular, with prices high, we've got some good opportunities we'll talk about here in a minute. The marketing side of things, I'll touch on quite a bit. Of course, we've got some great opportunities. Markets are making new highs again this morning. I looked just a minute ago. We had corn up 6 cents, soybeans up 30 cents on the nearby contract. So new crop beans up 17 right now. So we've got some good opportunities here for 2021. The last thing we'll hit on just briefly is government programs. Honestly, we do have a choice to make between now and March 15th. I don't expect this year that PLC or ARC are really going to matter with prices where they're at, but we do have to make a decision. So we will hit on that as well here at the end. So start out with markets. This is a picture of the Goldman Sachs index over the last 3 years. And what I really want to point out is, the variability we've had in prices. Now, keep in mind, this index isn't just crop markets. This is all commodities. This includes the energy sector. It includes precious metals, the soft commodities like sugar and lumber. But you can see back in 18 and 19, we had some relatively quiet years in the markets. Markets didn't move a whole lot. Commodities were pretty flat, all things considered. All that changed at the beginning of last year when we had the big COVID plunge. And not only in commodities, we saw the stock market drop hard at the beginning of last year when people recognized that the economy was going to slow down, not just the US, but world economies were going to slow, and the demand was going to possibly shrink. In the second quarter of the year, we started to see a bounce back, and that was partly led by the oil market. If you remember, oil traded actually to negative numbers in April. So theoretically, you could have taken delivery of barrels of crude oil and been paid to do it if you figured out how to do that. But that went away fairly quickly. I think people started looking at the reopening of the economy, which markets were going to respond quickly. Anybody that tried buying lumber in the last year recognizes that lumber is at all-time highs right now. And I know I tried to build a deck last summer. You couldn't find certain cuts. So that market really responded well in the COVID situation. But the ag markets really didn't do much until August. And we kind of had a perfect storm. I hate to use that phrase, but a perfect storm of events occurred at that point. We had the major derecho storm that went through Iowa. We even had damage reported as far east as northern Indiana out of that storm. So, and we really didn't see the final damage to that storm until the January crop report, if it's even been implemented in the USDA's numbers by then. So that was one big factor. We had drought. So both of those things combined really took the top off of supply. At the same time, China came in the market, started to buy to fulfill its obligations under its phase 1 trade deal. So you had a perfect situation where supply dropped, demand was rising at the same time. We haven't had that in many, many years here in the US, and it caused the big rally in commodity prices. And you can see that this index in the back half of the year and on into this year has continued to soar. And a big part of that is the ag markets that are pushing this index higher. Export sales been at a record level so far this year. Corn and beans combined, haven't seen anything like it before. And so the exporters are all happy. They're exporting the heck out of grains, and we're continuing to see that happen even with prices higher. One of the big reasons for the rally, we have to give credit to the managed funds. And I know we like to thrash these people when they sell the market. Certainly, we've had a couple of those instances in the last 3 weeks, but you have to give credit when credit's due, and that's these people have been big buyers. And if you can figure out the red line on here, now this shows the managed fund position over the last 11 years. Now this is corn, beans, and wheat combined. And if you look at the red line, this is 2020. And we started last year with the funds basically at zero net position. There was nothing going on worthwhile in the ag markets. We had ample supply, demand was stagnant, just nothing to really trade on. And even as late as the beginning of April, these funds were holding a zero net position. They sold it off, went short the market out into the early part of the summer, eventually short 400,000 contracts at the heat of the COVID outbreak. And even as late as the middle of August, they were still short about 200,000 contracts of corn, beans, and wheat. But look what they did the next 5 months. They went from short 200,000 contracts to long 800,000 contracts, really by the middle of October. So huge buyer, bought 1 million contracts combined of corn, beans, and wheat. So that was really the biggest reason we saw the rally that we've had. And as of the beginning of this year, you can look at the black line at the top. As of last week, they're still holding about 800,000 contracts of corn, beans, and wheat combined. So to me, again, give credit where credit's due. They've given us the rally, but also keep in mind that I think this is the risk that we have now as we go into 2021 is if and when these people decide it's over, they've got a lot to sell. Now, I don't think that's likely to happen this week or this month or who knows when. But history tells us that at some point they're going to be sellers. So keep that in mind when you're thinking about how to manage price risk here in 2021. So I want to start out with the soybean market because soybeans were really the leader in all of this. And you can see that export sales were the biggest reason. We had China come in the market back in August. This marketing year sales, the black line, we're above any year on record. Bean sales have been phenomenal. We're already bumping up against reaching USDA's target for the entire marketing year, and we're only halfway through the marketing year. So typically we see this line start to flatten out this time of year because we're moving demand to Brazil. However, and we'll talk about this in a minute, Brazil's awfully wet right now. They're really slow getting the beans out of the field, and you're seeing some of this demand come back to the United States. And so this is likely to see USDA bump its export number here in one of the future crop reports. And here's the latest balance sheet from USDA out about a week ago. The changes, they did raise export demand 20 million bushels, and they lowered ending stocks 20 million to 120 million bushels. And that number might as well be zero because at 120 million bushels, that's basically what's left in the bin bottoms and in the pipeline. So we really don't have any beans that you can access at 120 million bushels. The other thing I would point out there that's as of August 31st. We don't see many beans harvested in the first 3-4 weeks of September usually each year. So we're going to run out of beans is what this is telling us. And that's why you're seeing such a dramatic increase in the bean market here the last 2 days. Now that we're seeing a little bit of extra demand come back to the U.S. due to wet weather in Brazil, this export number is likely to be bumped in one of the future reports. Now, what's also likely to be bumped will be the import number. And it's causing a real strange situation in soybean futures right now. We haven't seen this since about 2013. That year we imported, I believe, over 50 million bushels of beans. And this is likely to happen again this year. We're going to ship out all of the available supply of beans right now on the front end, but we're probably going to replace those on the back end of the summer with beans out of Brazil. So don't be shocked when we hear the news that we're shipping beans into the United States. It's going to happen this year. And this has happened before. It's easily done into the Carolinas. You've got North Carolina, especially where you crush a lot of beans for poultry feed, for hog feed down there. That's going to happen. I heard a rumor 2 weeks ago that there's a company in Illinois that's looking at bringing beans up the Mississippi, taking them to Pekin, Illinois, and offloading them on rail. So expect that to be in the news. And I would expect in future USDA reports that they're going to raise exports and they'll probably raise imports. So it's a real odd situation, but that's where the world is right now, with China really hand to mouth needing the beans badly enough that they're willing to pay a big premium here on the front end. And the other reason for that is you don't want to leave a ship sitting empty, and we'll look at that here in a minute, but you pay demurrage on empty ships that are sitting waiting for loading too. And so that's sending some of these boats back to the United States. It's been a huge reversal in world stocks. If you look back 2 years ago, back in 2018, we had record world carryout of soybeans. And I know what gets the attention of most folks is that we had tariffs at that time from the Chinese. The reality was that China had killed off nearly 40% of its hog herd at that point, didn't need the beans. So you can afford to put a tariff on something if you're not buying it. And that's really what happened back in 2018. But since they got the swine fever outbreak under control, you've seen them really ramp up production and consequently ramp up demand for soybeans. I did see a story this morning about another type of swine fever. The market seems to be ignoring it today, but keep in mind that there's some, it's kind of tenuous situation here that if something like that happens again, we can see the bean market go the other direction. But at least for now, demand has been really eating away at the world supplies. And I think this is a really neat map that Pro Exporter Network shared. It shows you where the beans are grown in the world. And I want to start out looking at China. China grows 19.6 million tons of beans this year. China is going to import about 100 million tons of soybeans this year. So what they grow really doesn't hardly make a dent in their overall demand. They are extremely reliant on the Western Hemisphere. The U.S. had a crop of over 112 million tons this year. Good crop. South America combined is expected to be over 190 million tons this year. Most of us can remember not very long ago that the U.S. outproduced the Southern Hemisphere. So that has really changed in a big hurry. Brazil increased acres by 4% this past year. Does anybody think that's likely to happen again? I certainly think with $14 beans, you're going to see them continue to chop away at rainforest and scrub ground and continue to try to add more acres of production. And they had a horrible start to the year. They were about 2 to 3 weeks late planting some of the beans in northern Brazil due to dry weather, waiting on some rain. Once that happened, they eventually got the crop in the ground and ended up really having the best possible scenario of a growing season. Had timely rains late December, January to get that crop to what's projected at a record 133 million metric tons. Now their problem is getting it out of the field. It's been wet, it's staying wet in Mato Grosso and some of the northern areas, and they're having trouble getting beans out of the field. But overall, they should have a good crop. It's just a matter of when they can get it to the port. Argentina has seen their crop actually dip back just a little bit. Early on, estimates were at 50 million tons. We've seen that chip down. I've seen 46 million tons this week due to dry weather. Overall, it's going to be a big crop down there. It's just a matter of how big and when it's going to get to the market. But you can see Mato Grosso's harvest pace. As of last Friday, only 34.5% of the beans have been harvested. That compares to 58% average and 73% a year ago. So they're way behind getting that crop out of the field and remain wet. And you can see this was a forecast from about a day ago. This was a 2-week forecast, and it shows this area right here continuing to get inundated with heavy rains. And so that's a problem. You've also got drier weather. This doesn't dip all the way down to Argentina, but you've got drier weather down into Paraguay and into Argentina that could have some negative impact on the crop there as well. But these two pictures I pulled off of Twitter yesterday. The one on the left I did include with my market report email last night. Shows you the vessels that are sitting, anchored down probably, waiting to get loads in South America. It's incredible. Look at the number of boats that are sitting and waiting. And so this is because of the wet weather. And you can see there's the Amazon up at the top where some of the boats come in and load there. You've also got I believe it's the Paranagua port down below in South Uruguay that people are trying to get in and be able to load as well. So if you have an empty vessel coming back across the Pacific, do you want to send it to South America to wait in line? Or do you want to pay maybe an extra $1 or $2 for beans and send that boat to New Orleans and get a quick load? that's what's really happening right now, and that's why you're seeing the U.S. bean market really take off with this really odd situation. The picture on the right shows, I believe it was Highway 158 in Brazil. A lot of loaded trucks, but it looks like they've had some washouts as well. And so we seem to see these pictures every year, but nonetheless, pretty interesting to see what wet weather has had, the impact it's had on the bean harvest down there. Now, the other story I mentioned earlier is the funds. What are the funds doing? Well, they had a record long position back in the fall. They were long over 270,000 contracts of soybeans. They have whittled that down to about 206 here as of last week, but they're still very, very long the bean market. Now, again, I don't think there's reason that they're going to sell off anytime quickly. I think unless something dynamically changes like a swine fever outbreak, I would imagine that these people are going to maintain this long position because, and I'll show you here in a minute, we need to add bean acres this year. And so I think the market already recognizes that. But I do think this does point out the risk that we've got in the bean market going forward. And you saw a very similar situation back in 2017, the purple line, when funds were long about the same number of beans at this time of the year. But you can see what they did over the next few months. They went from long 200,000 to short 38,000 by the end of April. And so it does represent the risk, I think, that we have in soybean futures today. So two things I would point out looking at the long-term chart of beans. If you're bullish, and a lot of us probably are still, and by the way, if you have any old crop beans left, I have to admit, I probably wouldn't have. I'd have probably gotten rid of my beans at, this fall out of the field when markets were given good premiums. There was no incentive to store at that time. And so I think a lot of folks are probably in that boat. But if you've got old crop beans left, if you're bullish, looking for an upside target, I'd go back to 2014. 2014, we had a stocks to usage ratio at 2.6%. That's exactly where we're at this year, right now, according to USDA. And that year we took beans up into the 15s. So I would point to that as saying, well, if given a similar fundamental situation this year, maybe we need to take prices back to those levels. The negative, of course, would be where the funds are at today. And so if you want to try to manage this risk, but still keep your upside open, I would suggest a minimum price contract. And that's kind of been my buzz for this year, is using options. In past years, I wouldn't have wanted to pay premiums to buy options because we didn't have a whole lot of profitability left after you paid the premium. This year, even after you pay the premium, we've still got, you've still got some pretty good profit margin. So I like the idea of selling the rest of my old crop beans. Maybe I wait for this rally to see how far it goes, sell the rest of my old crop beans. Maybe I go buy a $15 or $16 call just in case this market keeps running. Go out to a July call, which would keep me in the market maybe through late June. Looking ahead, though, I think that the market has transitioned, at least it had the last 2 days, to looking at new crop. How many acres are we going to get planted to soybeans this year? We need to add a lot of bean acres just to get our stocks starting to build back up. The good news is we had a lot of prevented plant acres the last 2 years that should come back into production this year. 2 years ago, we had about 20 million acres. This past year, we had over 10 million acres of prevented plant. So you would assume, based on a fairly dry Midwest and because of record high, well, not record high, but 7-year highs in prices, that we would likely see most of those acres get planted this year, similar to what we had back in 2012 when we only had 1.2 million prevented plant. So what are they going to go to? The bean market, what I want to show here with this balance sheet exercise is that beans need a lot of acres. And the first set of numbers I would look at were from Farm Futures Magazine. About 2.5 weeks ago, they released their planted acreage estimate. They only had 84.5 million bean acres. That's only up 1.4 million from last year. With an average yield, and even if I reduce my demand estimate for this coming year, we would run out of beans. We'd be 73 million bushels short of zero. So that can't happen. We've got to add more acres than that. Bloomberg a week ago put out its trade estimate on acres at 89.4 million. Again, using a trend line yield, using a somewhat conservative demand estimate, we could build stocks up close to 200 million bushels. That's not burdensome by any means. That's only up 76 million from this bare bottom year that we've got right now. The Ag Outlook Forum last Thursday and Friday released an estimate of 90 million acres. And again, going through, these are their numbers on production, their number on demand. They're forecasting demand similar to this past year. That would only take stocks up to 145 million bushels. Still bare bones tight. They're estimating average farm price at 11 1/4. So the next column is what I think is needed. I really think we need to get 92 million acres of beans planted this year. And with the trend line yield and with decent demand, you could get stocks back up to 300 million bushels. And I've always considered 300 million to kind of be the teetering point on soybean stocks. If you're above 300 million, things are fairly comfortable. But when you get below 300 is when you start to see the markets react. You start to see some price rationing talked about. And so can we get to 92 million? That's up 9 million acres. I don't think we can, to be honest. I don't think 9 out of that 10 million prevent plants going to go to beans. The people I've talked to around the country, throughout the Corn Belt, we have a liking to planting corn versus soybeans generally. And if you get up into the Dakotas, where we had a lot of the prevented plant last year, those guys had a dry fall, and they were able to get all that prevented plant ground worked up, get a lot of nitrogen put on it. So the only way beans are going to grow is by taking acres away, maybe that were intended to go to corn, through some rotations around the country. And so, yes, I think we can get bean acres maybe up to 87, 88, 89, maybe 90 million. I don't think we can get to 92 million. And so I would look for bean stocks to continue to be tight in the year ahead, assuming that demand with China continues. So when I look at November futures, made a new high this morning, and this was as of a couple hours ago. So I think we're trading a little bit higher even right now. Look at the bottom of the chart. The RSI is up to 70. The stochastics are still rising. So while this market may be inching into overbought territory, I don't think it's probably there just quite yet. If I'm going to look to do some marketing, I'm probably going to look to sell corn more so than beans. But if I don't want to let this bean price get away, the strategy I would consider would be, again, a minimum price contract where I could sell beans today, November 12/24, maybe go buy a $14 November call option. If I'm, depending on what level I buy, you might be able to start getting some floors locked in at $12 now by the time you subtract the cost of the call option. And that's an incredible opportunity versus what we've been doing the last 7 years. So, to think about locking a floor at $12 while keeping some upside in the market, I think that's great. The other strategy that I'm focusing a lot this year is crop insurance, and the fact that we've got some new tools available. And we are in the pricing period. We've got 4 days left, as Nathan said, in setting our price. And right now we're averaging 1176, and that number is going to continue to climb a little bit. We're probably going to be in the 1180s before it's all said and done here on Friday night. But the other orange lines represent crop insurance. And so let me kind of go through what I mean by this. And I'm a marketing guy, so I like to look at revenue policies from a market standpoint. What price support am I getting with a revenue policy? And essentially, I'm getting a put option on price. If price goes down, then we could start to trigger a payment. And for this exercise, I'm assuming that we have an average yield on my farm and an average yield in the county. We don't know what's going to happen this year, so let's assume we have an average crop. If that's the case, and if I buy an 80% revenue protection policy, an RP policy, then with an average yield on my farm, it would take a 20% drop in price to start to trigger an indemnity payment. And in this case, that gives me essentially a floor around $9.55 a bushel. It's quite a ways down from where the market's at right now. What if I use the SCO policy? SCO is Supplemental Coverage option. That was new about 3 years ago. We may or may not have talked about it a whole lot, but it is county level coverage that stacks on top of your individual coverage up to 86%. So in this example, if I'm buying an 80% RP policy, I could add 6 percentage points of county level coverage. And in this case, again, if Johnson County or whichever county you're in has an average yield this year, now my price triggers up to about $10.10 a bushel. This year, we have a brand new program that just came out called ECO, which is Enhanced Coverage Option. ECO allows you to get up to 90 or 95% county level coverage subsidized by the government. So basically, I'm looking at this as a subsidized put option. And if I were to bump or add extra coverage up to 90%, now a 10% drop in price gets my floor up to about 1060, and a 95% policy, a 5% drop, gets me up to about 1115 a bushel. Now you're really talking about some real price protection from your crop insurance policy. Plus, you've got bushel protection if the county has a loss. In this case, if I have 95% coverage and the county has a 5% bushel loss, we start to trigger a payment. And if we have a 2012 situation where the market goes up, which it could easily with a bushel loss, then we get paid on those lost bushels at the higher fall price. So you've got three things working inside a revenue policy. If we would have had this policy out last year at this meeting, we would have mentioned it, but we probably wouldn't have talked about it a whole lot, because we more than likely wouldn't have wanted to pay the extra premium to add the coverage. This year, with the opportunity, with where prices are at today, we can really get some higher price triggers with these extra policies. So the corn market, very similar to beans. Corn has been really driven by the export business, and corn has really been more of a surprise than beans. I think beans, we all knew that when China started to rebuild the hog herds, that we would start to see the demand show up. But corn has been the shocker. Most of us didn't see this coming, but China's been importing a lot of corn this year, and you can see our pace has been a record pace so far this year. And in fact, a couple of weeks back, China had a huge buying week of corn, and that's showed up here in this vertical part of this line as well. So again, kind of like soybeans, we're on pace to possibly reach USDA's target for the whole year really, really early in the marketing year. And I mentioned China, but you can see what they've done on corn imports here. Yes, they've imported corn over the last decade. The majority of that came out of the former Soviet Union. They really haven't bought U.S. corn. They've been buying DDGs, they've been buying sorghum. But now, and maybe you could credit that to the trade deal, whatever the case is, China's been a huge buyer of corn. I've seen two theories on why they've been buying corn. One theory is that they were much tighter on their stock situation, or at least usable corn stocks in China, than what USDA and other analysts had been projecting. And so maybe they did have bushels, but maybe they were, the quality was poor and they couldn't use those bushels. So that's one theory. The other theory is that China's loading up in anticipation for, who knows, a potential geopolitical fallout with the United States or something like that, maybe over Taiwan. And so that's been one theory. Whatever the case is, we're good with it that China's buying a lot of corn this year, and it's certainly given us the boost that we've seen in the markets. So when you look at the latest balance sheet, USDA did raise exports by 50 million bushels. They did lower ending stocks by 50 million down to 1.5 billion. Now, this is not near as tight as bean stocks, but 1.5 billion to me is kind of the equivalent of 300 million beans. It's the point where you start to see some rationing take place if we fall below that number. When this report came out a week and a half ago, the trade was really disappointed. The trade all expected exports to be higher than this and ending stocks to be lower. So I think that we're already focusing on an ending stock number down maybe 1.3 to 1.4 billion. I think that's what's being traded today, not this USDA number. And we do expect USDA to raise this export number in one of its future reports. So again, I think the risk, again, the reward has been the funds. Funds have been the driver in this thing. They've gone from a huge short position in corn last summer to a record long position here over the last 30 days and still holding over 500,000 contracts of corn right now. So this is probably the biggest risk that we've got going forward. Now today, funds are buyers again. So again, give them a little credit for the rally, but keep in mind that this at some point is likely to reverse. Just don't know what's going to cause that to happen at this time. And when I look at the monthly chart on corn futures, you go back and compare to like 2013 and 14, 14 in particular, we're looking at stocks to usage pretty similar to that year. And so prices are quite a bit above that year. And so maybe we've got a little extra premium being built into the corn market today. And I'm in the same position as it was soybeans. If I've got old crop corn left, and if I want to take advantage of the rally, probably looking at a minimum price sale where I could hedge my corn or sell it versus 553 futures. Maybe go out to July and buy a $6 or $6.50 call for maybe I spend 20, 25 cents a bushel. still have a floor price well above $5 futures with potential upside. So I think that that's the way to go here to market the rest of your old crop corn. Looking at the balance sheet, the one point I would make on the balance sheet is going to be a lot easier to add corn stocks this year than it is to bean stocks. Beans have to have a huge chunk of acres this year. Corn, you can see if you look at the Ag Outlook Forum numbers, they were projecting 92 million acres with a trend yield at 179.5. You could get a crop over 15 billion bushels. Now, they were also projecting demand to be over 15 billion, which I think is a pretty big stretch. But if it were to happen, we would still build stocks about 50 million bushels this coming year. Not a big jump. They're projecting a slight drop in average corn price. Bloomberg came out with a number at 92.9 million acres, up about 2 million. And I plugged in a trend yield would give me a crop of around 15.4 billion bushels. I'm using demand similar to this past year. And with that, I would bump my stocks up over 2.2 billion bushels of corn this year and likely see corn prices quite a bit lower. Farm Futures Magazine, in their survey, they had 94.7 million acres. I think the truth is probably somewhere in the middle of this, maybe around 93 to 94 million acres. But with a trend yield and with fair demand, you'd be looking at stocks pushing up towards 2.5 billion bushels this year. So again, I think what I wanted to point out here is that it's going to be much easier to build corn stocks this year than it is soybean stocks. And so the markets need to do the job to swing some of these fringe acres over to soybeans. I don't know that that's really happening right now. And when you look at corn futures today, we were making a new high again. December corn traded to 474. So that ratio between November beans and December corn really isn't widening enough to me to swing a lot of extra acres to beans at this present time. So if I'm looking at doing some marketing, I tell you what, I was excited back in December when we hit 420 Ds. You know, that was a starting point for a lot of folks. 450 Ds was another selling point that I think a lot of us were interested in. If you're looking at playing catch up with some sales, I like the idea of being a little more sold in corn than beans. And so I could hedge corn today at 470, maybe go buy a $6 December call. Now, granted, that's a little out of the money, but I don't want to spend a ton of money on that option. And as of the end of last week, that was trading at about a dime. So I could essentially get a floor around 460 D's corn while keeping some upside open if we had a runaway market for some reason this year, if we had another 2012. If not, I've got a floor at 460 futures minus my basis. Again, tremendous opportunity that the market's given us today. Rsi and Stochastics still look like they're kind of trending in a higher mode. Again, go back to crop insurance. We looked at these orange lines with beans before. As of right now, we're averaging 455 with 4 days left. I would assume that number is going to push towards 460 if prices stay where they're at right now. So if I bought an 80% RP policy, I'm really with an average yield only have price protection down around 375. If I add the SCO, supplemental coverage, with an average county yield, my price trigger gets up above 390. If I add the ECO up to 90%, now I can get my price trigger up to about 410. So, you know, you look back at the chart, we haven't been above that level, but for about 3 months now. So that gets me some really good price protection built into that revenue policy. And if I go to the 95% level, now I'm pushing up around 430 a bushel. This last weekend, I sat down and tried to figure out what would a 430 put cost, say, and I did this on 200 bushel an acre corn, but that would cost me about 56 bucks an acre. I would guess you could do this series of stacked policies, RP plus SCO plus ECO, for well below $50 an acre. So Nathan can help tell you what those quotes would look at. But the point is that if I'm looking at just buying puts to protect the crop, I can get a cheaper subsidized put with my crop insurance, and I get bushel protection, and I get upside price protection. So that's the beauty of the subsidized policies that we have available here for this year. Weather, I don't want to spend much time. I'm not a weatherman, but I got 4 slides to show you on what we're looking at going into spring and summer. The latest drought monitor that came out last Thursday still shows over 50% of the United States in some form of drought right now. And the forecast out through the end of May continues to show the western half of the country remaining dry all the way out through spring. I was in the Dakotas and Nebraska the last couple of weeks. I know this area, if you go back about 4 days ago, you probably had more snow south of Indianapolis than a lot of South Dakota and North Dakota did. And so they're not sitting on much snow cover at this point in time. And even though that's going to let them get to the field early, it is causing some concerns as well. The green areas, this little sliver from Illinois and Indiana, is expected to improve a little bit during that period. And that's probably because of the forecast. If you look at the latest CFS forecast, March, April, May does actually show above normal precipitation this spring. So if you're dry, maybe that's going to help subsoil. If you're going to be on the moist side, maybe that'll cause some havoc. We'll wait and see what happens. The summer forecast, this is May, June, and July, which starts to show a lot drier conditions through much of the country. And actually the June, July, August map was even drier yet. So maybe not the best forecast if we're going to be wet in the spring and dry in the summer, but something you may want to consider